Indian Bank is in focus on the back of its Q4 numbers. Slippages remain elevated and high write-offs have aided gross NPAs. To discuss the quarter gone by and the outlook going forward, we are now joined by Bank's Managing Director and Chief Executive Officer, L Jain. Mr. Jain, good morning. Thanks a lot for joining us. First, if you can tell us why were the slippages elevated and will it remain the case in coming quarters?
Good morning and thank you for the opportunity. If you see, our gross NPA and net NPAs is continuously coming down YOY as well as sequentially. As far as slippage of this quarter is concerned, it is around 3,300 crore, and here are one big account of a retail around 850 crores. Remaining is 2,200 crore, majority of which is in MSME.
Good morning, Mr. Jain. Thanks for joining us. I was looking at your write-off figure. It's quite a big amount this time, around 2,200 crores. Can you tell us why you've taken this kind of a big write-off?
Write-off basically we takes care of two reasons. One, wherever we are doing OTS, we do a write-off for the balance amount is one point. And second point, technically we return off the account to get the taxation benefits.
Okay. Mr. Jain, you're right that NPAs are coming down, but at 8.5% gross NPA is still quite elevated. Slippages too at what, 20% quarter on quarter. Can you give us some guidance in terms of how things are looking to pan out over the next few quarters? Are there accounts that might come under stress? I mean, what is the outlook?
You see our net NPA, important thing is what is a net NPA unprovided for amount. 2.27%. It has come down from 2.72 to 2.27, 1 point. Second point is basically, you see my SMA book and the collection efficiency. The collection efficiency, which was 88% in March last year, has improved to 95%. Second point is, you see the SMA 1 and 2. SMA 1 and 2 is 0.93% of our book. So when your SMA is coming down, naturally the slippage going forward will be less. And therefore our gross and net NPA should come down the time too.
Okay, what was that one account, that retail account that you referred to, Mr. Jain?
Yes, yeah. Retail account.
Yeah, which company, if you could tell us?
This is a retail chain in the country.
A retail chain in the country, listed, right?
Yeah, it is listed.
Okay, got it. I think we perhaps will know the answer now. Okay, outlook on margins and NII going forward?
Yeah, especially our margins are concerned. It has improved in the year-on-year basis by 6 basis. And now we are in increasing interest scenario. So what happens in the deposit side when we are having 42% of our CASA, which is unaffected with the increase in interest rates? Remaining is a retail term deposit, and when here, if we increase the rate, it comes with a lag effect. Whereas on the credit side, in asset side, where our 42% portfolio is a repo link. So, and RBI has just increased the repo rate by 40 bips. But immediately our repo link interest will reprice and will get a higher income. So going forward, when your 42% is CASA, so liability side, more or less you are protected, and asset side, it is increased. So my margin should at least protect or should be better.
How much better do you see the margin? So for now, it was around 2.9%, Mr. Jain. Where do you see the margins trending?
Going forward, actually, it depends on how the RBI increases the repo rates, and the timings of the increase in repo rates is a one factor. But considering liability, my existing liability profile and my asset profile, I'm hopeful that my margin should be at least up to that level.
Okay, could you also tell us what is the estimate that you're working with in terms of your loan growth? What do you expect for, say, FY23, and also what are the credit costs looking like?
So if my asset book is concerned, RAM, which we call retail agri and MSME, is 61%, and the RAM portfolio is growing at a rate of 11%. So we'll continue to grow at that speed. So 6 or 7% growth comes from that only. And you see my corporate book is also growing quarter on quarter by around 2% or so. So considering all these facts, I'm hopeful that minimum we should be able to grow between 8 to 10% in the financial year. And it can be better because as the commodity prices are increasing, the working capital utilizations are increasing.
All right, Mr. Jain, we'll take that point. Thank you very much for joining us today and taking us through your outlook for the company. But with that, it's time for another short break on the show. When we return, we're going to discuss